Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is industrial real estate expert and repeat guest, Chad Griffiths. Now, Chad has more than 16 years of experience in industrial real estate and has completed over 500 transactions with clients ranging from local companies to large institutional owners. Chad has been a top 15 producer countrywide since 2013 and is a partner with his local firm. In addition to earning his SIOR and CCIM designations, Chad has a diploma in urban land economics from UBC and an MBA from Thompson Rivers University. Now, Chad has given numerous interviews locally and nationally regarding the commercial real estate market and has had articles published in Forbes, Western Investor, and Real Estate Magazine. And guys, we had Chad on the show a few months back. I believe it was back in March or April. It's probably April when it got released, but we did the interview in sometime mid-March. And we seemingly ran out of time during our interview together. And so he's back now for, I guess, what we can call part two, where we'll clean up any loose ends that we might have missed on. And a lot's actually happened since we had him on the show last. So I'm excited to welcome back Chad Griffiths. Chad, how you doing, my friend?
I'm doing really well, Kevin. Thanks for having me on the show.
Yeah, no, I'm excited to have you back. And it's funny how much has changed just over a very, very short period of time. And so I'm excited to dive into it, my friend. So, but what I'd like to do, again, just in the event that someone had not listened to our interview together, maybe just take a minute or two and you'll fill in any gaps of that introduction I gave for you about, who you are and ultimately what it is you do in real estate.
Yeah. Thanks for that, Kevin. And to your earlier point about there being loose threads to tie up from the last interview, I think there's a whole bunch of new threads as well
that's
that
true.
we'll jump into. There's a lot that's happened in the last couple months. But yeah, I've worked in industrial real estate since 2005. I've been at the same company the entire time. 2014, I started investing in industrial real estate myself with partners and a lot of bank financing, which is a topic of the day right now. We've accumulated a decent portfolio. We've got about $18 million worth of real estate that we directly own right now. I'm a direct partner in all of it with my own equity in it. So I can state unequivocally that anyone that's out there questioning what's happening in the economy right now and interest rates and inflation and recession, I'm in that same boat because I have the majority of my net worth directly invested in industrial real estate right now.
Yeah, fantastic. I appreciate that, Chad. And again, talking about all the massive changes and new threads, as you put it, that have come about over the last couple of months since we last chatted. And, the biggest one really being, interest rates and just the extreme volatility that's occurred. Again, we spoke again. I don't know the exact date. It was mid-March sometime. And from that point to today, and we're recording this on June 14th, the 10-year treasury has jumped roughly 150 basis points. It's just shy of that, but roughly 150 basis points in that very short span of time, and nearly 200 basis points from January of this year. So, 6 months in, and we're seeing massive shifts in the marketplace. And so I guess the first question I have, specifically related to industrial sector, which ultimately, really spills over into a lot of other asset classes in commercial real estate, but more specifically, let's talk about industrial here today. How are buyers and sellers at this point in time, again, given the extreme volatility that's occurring, how are they navigating these turbulent waters? I mean, what type of sentiments have you seen change, if any?
Yeah, I think the first thing I'd say is that it's important to recognize that the Feds are intentionally trying to slow down the economy. That's what they're intentionally trying to do by raising interest rates, is to combat inflation from getting even further out of control. So the Feds are intentionally trying to make things more expensive. By default, anybody that's taken on new debt, and this isn't even just somebody considering buying a property. This is anybody with a property that might have floating debt right now or might have a renewal coming up. I've got one the closest one I have coming up is about a year from now, and even that's starting to scare me at what that interest rate will look like in relation to what we're bringing in revenue. But that's the Fed's intent. So if the Feds are intending on slowing down the economy, that means that every investor is going to have to take a second look at what they can actually afford, what property they can support, how much debt they can support in relation to the purchase price. So I think to some level, at least looking at this very high level, buyers are going to take a second look at what they can pay for a property. But I say that also in the context that interest rates, even as they are right now, are still historically very competitive.
Mhm.
Outside of like a few aberrations, like the financial crash in 2008, 2009, and what we went through the past 2 years, interest rates we're like right in that ballpark. So there shouldn't be that much of a surprise that interest rates are starting to normalize from a historical perspective. But there's that sticker shock. Anytime you see a 150 or 200 basis point increase in interest rates, that affects the whole market. So I think at first blush, as a like a reaction, what investors are going to say is, okay, I can afford to pay less for this property, and in the extension of that is the property is now worth less if the pool of prospective buyers can all
Yeah.
pay less. I'm still I'm still unsure at how this will actually relate to properties going down in value, though. It makes sense that that's what the effect would be, but there's nothing that occurs in a vacuum. A buyer's decision to
Mhm.
what they can pay for a property isn't made in this tight vacuum of interest rates go up, so now I can pay less. The reason interest rates are going up is because inflation's going up. So I always like to look at it as, what is the alternative? If you don't want to invest in commercial real estate or invest in anything for that matter, it can be stocks, crypto, which you and I aren't overly familiar with ourselves, but is still a viable opportunity for a lot of people. Whatever you're investing with, there's an opportunity cost with that. And the opportunity cost might be leaving it in just cash. But if inflation, and the numbers just came
Mhm.
out the other day, was still 8.5%. If you just leave your money in cash, you're perhaps eroding the value of your money 8.5% every year. So there's a risk with everything that you do. Doing nothing means that you're
Mhm.
having your value of your cash eroded by just inflation, versus putting it into a hard asset like commercial real estate or self storage, or any type of investment. If you're putting it into a hard asset, are you are you keeping pace with inflation? Are you perhaps at least being competitive with inflation versus leaving it in your bank account? So I think that this will be a story to follow very closely for the next several months, if not for forever. Like, this might be on the top of investors' minds going forward in perpetuity. But what do they want to invest in versus the alternative of just leaving it in cash?
Yeah. Well, let's speak to I gave you an example before we started the interview here about a triple net deal that we were looking at buying, and ultimately we're buying a spread at that point in time. There's still about 5 years remaining on the lease, and so this is by all means us buying a stabilized deal. There's not a value add play, and so knowing that even at 6% rates, that's historically low, and I can make sense of that equation and understand how one can still assuming property values don't adjust, cap rates stay at the compressed level that they're currently at for whatever asset type you might be looking at, one can make sense of that equation if there's a value add opportunity in that particular acquisition, right? But how does one make sense of that particular investment when it's a triple a triple net lease deal that has only incremental increases on an annual basis that are nowhere near what current inflation is at? How does that financial model look?
Looking at it in isolation, in terms of not having any idea what the future looks like, and
Yeah.
what interest rates do or the economy does, I personally take the look through like my own lens as an investor, that there's a few different ways that you can make money in real estate. You can pay down principal, you can get appreciation and top line revenue growth, which is the underlying value of a property itself, and you can get some tax benefits along the way. So there's different reasons to look at it. But if you were to extrapolate out a holding period, and let's say you looked at that property for 5 years that's remaining on the lease on there, you're going to have all these different measures that the property can essentially appreciate. And in a rising interest rate environment, that's going to mean that you're going to have less principal pay down. You're going to have potentially some constraints on top line revenue growth on what that tenant renews for in 5 years. But those things still don't change the underlying value that you have a hard asset that's there.
Yeah.
So maybe instead of projecting out a 12% IRR, just using an arbitrary number, maybe your IRR looks like it's 7%.
Hmm.
And that's a pretty big swing. But contrast that to not doing anything, the decision to just leave
Yeah.
that money in a bank account and have it be eroded by just general inflation. all of a sudden 7% return looks a lot better than negative 7%
Mm-hmm.
return. So I still think that there's a large appetite in the lending community to deploy capital. There's a large appetite on the investor side of a lot of investors sitting on money. They have to make a decision on whether they think the market's going to fall to a level that they can enter into it. And I don't know about you, Kevin, but I can't predict the bottom on anything. Like anytime I think that I'm at the
Yeah.
bottom, as I'm way off. So it's impossible to predict the bottom on that. So you either have to just make a decision to accept some amount of risk, or have the inevitable risk that just comes with eroding the value of your cash through inflation.
Are you noticing any pullback or even initial trepidation from either buyer or sellers at this point in time? Or no, is it just business as usual as it sits today?
It's a conversation. It's coming up often. Like sellers are asking questions, buyers are definitely have a little bit more trepidation right now. So I would say it's top of mind for everybody. I mean, that's what going back to the real comment. That's what the Feds are trying to do. They're trying to put a little bit of water on this huge economic fire that's just spiraled out of control with all this money that's been printed into the system. So it's definitely top of mind. I don't I don't suspect that it's going to crush the market in the sense that I don't see a massive downturn, like call it a 20% drop in values. I could be way off. I mean, I have no idea what's even going to happen tomorrow. The Feds could say that they want to increase 125 basis points for all we know, and that could change the narrative. But I think for every one buyer that says, I'm going to hold off on this, I'm going to wait to see what happens, there's another buyer that says, I want to get into the market. I'm a 10, 20-year hold on this. So
Mm-hmm.
these short-term aberrations aren't even necessarily that relevant to me. Maybe that's a high level thought, because I think to some level everybody's concerned about these interest rates. But if you're looking at it for the long term, and you might have an opportunity come across your desk that otherwise you wouldn't in a heated market,
Mm-hmm.
it's hard for me to give any investment advice to anybody, as I've made mistakes along the way as well. But I think if you've got an opportunity to get into something and it makes sense, and you know what your downside risk is, and you can still build out a decent pro forma that makes sense to you,
Mm-hmm.
sitting on cash is still a risk. So I think
Yes,
you got to do
I
something
agree.
with your money right now.
Now, you're switching gears a little bit. E-commerce. Let's just talk about the consumer spending habits, and ultimately let's try to forecast out a little bit what might occur. Again, I'm just looking at. We talked about. I was looking at my Twitter feed, and was just a number of companies as of today already are reporting major layoffs. 10% of workforces, 12% of workforces, and I think that's just the beginning of the the card stack falling down. I think that we're ultimately going to hear a lot of other those announcements over the coming days and weeks, but time will tell, right? With that all being said, consumer sentiment is ultimately going to change, and people will start retracting a little bit, spending less money, just not knowing what the future holds in store for them, try to protect the money that they do have, and again, just try to be a little bit more budget conscious. With that being said, that ultimately might impact retail sales, and more specifically e-commerce platforms. Most of them operate out of industrial type buildings or centers, and so is there any direct correlation or impact that you foresee occurring to these industrial landlords or investors as a result of a potential downtick in e-commerce sales?
Yeah, great question. And you're right, that is a very important topic right now. I'd like to look at the amount of money that consumers have to spend as a giant pie, if you will. It can be any kind of pie, maybe like a delicious apple pie. But that pie represents all the amount of money that people can spend on whatever that they want, any kind of consumer good. And of that pie, some percentage is going to be for brick and mortar retailers, like the
Mm-hmm.
traditional shopping centers, and then some portion is going to be for e-commerce. And there might even be like a third slice of omni-channel companies, and that generally refers to companies that do both. But to some extent, that pie is there, and that pie represents all the money that consumers can spend. So if e-commerce grows, that's taking money away from brick and mortar retailers.
Mm-hmm.
And conversely, and this is what we're actually seeing a little bit of right now, Amazon just announced that they had a 3% decline in e-commerce sales
Mm.
first quarter of this year. So that's only one company, but they're the largest e-commerce company. So if they're actually seeing not just a slowdown, but a retraction in that, that means that either that brick and mortar retailer has taken more or the pie has started to shrink. And
Hmm.
I think if we go into a recession, which I'd be personally shocked if we aren't already in a recession, that pie starts shrinking. That's not good for anybody because now there's just less money to spend.
Hmm.
So I think we're seeing glimpses of this right now where there will be some more financial decisions made on how much people spend going forward, and undoubtedly that will have an impact on both brick and mortar retailers as well as warehouse space, which has grown to accommodate all this e-commerce sales.
Hmm.
So I do think that there will be a slowdown in that regard. Where there's a bit of a safety net or at least a cushion is that some of these markets still have very, very low vacancy rates.
Yeah.
And I could point to New York or Los Angeles, these major port markets, which are sub 2% vacancy rates. And that's not a healthy market either because companies are being forced to pay premiums to rent space. There's shortage of spaces. This all leads to the bottlenecks and supply chain issues we all hear about. So I think that having an increase in vacancy isn't necessarily a bad thing either. It will be if it gets to the level where some of these investors are now underwater because they bought at the height of the market
Hmm.
and now the vacancy has risen to a level that just doesn't make it economically viable. Then we might have a problem on our hands, but I still think that there's a long runway before it gets to panic level in the industrial space.
Are there any markets in the U.S. that are at a point where there's a fear of oversupply in industrial, in any major markets that actually really, make a difference?
Well, I think to some level, all of them are at risk of overbuilding because just the pipeline of getting product onto the market can take anywhere from 12 to 24 months.
Yeah.
So when this boom started happening in, call it July of 2020, some of these projects are now just starting to get underway or they're starting to be finalized. So there's been a considerable amount of new inventory added. I think at last time that I checked in the US alone, there was 600 million square feet worth of inventory underway. So there's definitely the risk, and this is the cycle of real estate is that there's an increase in demand, so suppliers race to get to it, and this is the form of
Hmm.
developers or just companies that want to add more inventory. There's a race to supply that demand, but the supply takes longer than the demand can shift. We've seen how quickly this has been in the course of a few months. The demand has shifted noticeably, whereas that supply takes a lot longer to adjust.
Yeah.
So I think in the history of real estate, there's always this imbalance at some level between supply and demand. Right now, I would say that demand is still at a high enough level that there doesn't appear to be cracks in that system. But that's certainly something we need to watch going forward because it could very easily happen that supply outpaces demand.
Yeah. An extreme example of this, and more specifics probably than I do, but I remember reading a story about Peloton and their
Yes.
manufacturing plant that they built. I think it's at least, maybe it's 1 million square feet, maybe it's a few million. It's definitely, I believe it was at least 1 million square feet. It was a fairly large facility. We'll leave it at that, a
Yeah.
big footprint. And somewhere in the Midwest, again, don't even remember the state or the market that it's in, but ultimately it was as a direct result of the increased sales, massively increased sales during the pandemic, and they weren't able to create their product quick enough overseas, and ultimately made an executive decision to and you can fill in the blanks. I might probably be messing this up a little bit, but ultimately decided to build a very large manufacturing facility here in the U.S. and now literally will not be occupying it. It's that's a very interesting dilemma to find yourself in. And so I'm wondering if there will be other companies like that saw a massive increase in demand during the pandemic that ultimately has trickled off thereafter. It almost seemingly I've started to see some hints. I follow through. I don't have any short-term rentals, but I follow for whatever reason. I'm just intrigued by that business model. Always have been, and I have no intent in buying any. But I follow a few threads, like Airbnb threads on Facebook, and it's been a common topic that I've seen on many occasions in various markets across the country, that their rates have seen a significant decrease and bookings have seen a
Mm.
significant decrease over the last 12 months. Um, number one, due to now folks can travel abroad. During the pandemic, they basically did staycations, or they just did drivable distances, right? And so, but now they can go wherever the heck they want to go now that the pandemic's kind of over. But also an oversaturation. Everyone had extra capital flowing around, and Airbnb seemed like a very viable business model. And so, hey, husband, wife, we've got some extra money laying around. That seems like a really cool, business model. And I've stayed in Airbnb. It was really nice. Let's go buy one. Let's go buy one at our favorite lake or at our favorite resort or up in the mountains, what have you. And a lot of people made that decision. And so there's a fairly significant saturation of Airbnb and VRBO type of rentals, short-term rentals. And anyway, I've kind of seen that playing out as well. And you can say that's a direct result coming out of the pandemic. And so I don't know if you've had any other examples of something such as that as it relates to industrial.
Yeah, a perfect example is Amazon. So, in not only did they see a 3% decline in their sales, in that same report, they announced that they're intending to sublease between 10 and 30 million square feet worth of warehouse space.
Okay.
And in that seems like a big number, but in context, it still represents a very small amount of their portfolio, and a significantly smaller amount of the entire industrial portfolio. But that still should raise some eyebrows that Amazon, much like everybody else who was thinking that business is so good, we have to get ahead of this and make sure we're fully stocked in literal warehouse space.
Yeah.
Then they hit a limit where they said, we actually saw a decrease in sales now, so we need to put a pause on warehouse expansion. So not only are they not, or are they looking to sublease 10 to 30 million square feet, but they're also not proceeding with anything newer. So that was a big driver of the industrial real estate economy, was Amazon taking on space. I'm sure it's the same in your market as mine, Kevin, where Amazon is like everywhere. Like they've so
Yeah.
much inventory in our market right now, and they basically have said, we're not taking any more for the foreseeable future. So I think that there is a case to be made that a lot of these companies have reached the limit on what they need, and there'll be some pause taken for them to reconcile how much they actually need in relation to their business requirements. But it was really a product of the government injecting a ton of fresh money into the economy and people taking advantage of it. So consumers spent more on consumer goods, and companies built out their operations. And it was just this fuel that got put onto the fire that in the course of 2 years, I'm sure we'll look back on this down the road and just say there was so much economic expansion as a result of the government injecting so much money, I think we'll look back on it and say, how could there not have been runaway inflation after this?
I feel like that happens after every correction. We look back and say, how couldn't we have seen that?
Yeah.
It's right beneath our nose, right? And seemingly, I think all of us, to a certain extent, at least in the business world, knew that there had to be some direct impact as a result of the pandemic. Like you can't go through a period of time where you shut down the majority of the world for an entire year, and then still 80% of it shut down for the second year, and expect that nothing bad comes out of the other side. I mean, it's just in any event. Well, now here we are. We're dealing with it, and hopefully, I don't think we're going to see the soft landing. I'm not sure how hard it's going to be, but wishing everyone the best as we kind of push through these uncertain times here in the coming, again, months and years. And so I guess, again, back to industrial real estate, what are some of the other very top of mind conversations that are occurring in your industry that you feel are relevant for the listeners today?
Yeah, I think that the main ones are what is the price you should be paying, which we addressed. It's difficult. It's a moving
Yeah.
target, and just the volatility right now is hard to gauge. Like industrial real estate has historically been a very stable, almost by nature, like an unsexy asset class, where it's boring. It's tucked away in an industrial park. It goes up kind of like the pace of inflation, and now there's a potential for volatility, not just on the upside, which we've seen over the past 2 years, but what does that downside look like? And nobody has a crystal ball to project what actually happens. Is this a smooth sail through there? Is there pain coming? I suspect that anybody projecting large increases in rents or values this year are going to be disappointed. I can't see a scenario right now where there's going to be aggressive growth. Consumers are going to have less money to spend. Companies are going to have less money to spend as a result. I don't see a bull case for saying that rates are going to rise and values by extension are going to rise. So I think that we're kind of like best case scenario is it hums along. and people just wait to see what happens. But I think another case has to be made that it could get worse. So how are people preparing for that? Do they have contingencies in place if a tenant can't make a rental payment, or values drop and they've got to refinance their property, and perhaps they don't have enough equity, so they've either got to top up the equity or sell the property? These are considerations that I think a prudent investor will need to be cognizant of going forward. I still believe that real estate done well is a long-term game. It's a minimum 5 to 10 year hold. Myself, I've even got a 20-year outlook on my money. So I'm not as particularly concerned, and that's a bad way of saying it, because obviously I'm concerned what happens with these interest rates and everything going forward, but I'm less concerned than I am what that property is going to be worth 20 years from now. So I think if you have that outlook, these short-term aberrations can be painful, but it won't last. No recession has ever lasted. Well, I guess if we go back to the Great Depression, which was long before you and I were around. I mean, that was probably a 10-year set of pain, but I'm still bullish long term. But I definitely think that there is some pain coming in the short-term forecast here.
One thing we didn't chat on, even maybe we hit on it last time, but I don't think we went into depth at all. And it's interesting because the media puts out what they want us to to read, and will ultimately, like you mentioned earlier, get the most clicks. And you would think that the war in Ukraine is over, because it's definitely not top of mind. It's surely not the one of the main headlines that we're finding in our news feed every day. And so, have there been any impacts, or do you foresee any future impacts as a result of that war that's going on, and as it relates to industrial real estate?
Yeah, and it's such a profound thing to notice that we're not being shown what's happening in that war right now, because back up 3 months and that was all that we heard about. That was what everybody was talking about, and that hasn't changed. There's still just as much conflict there as there was, but I think that just really speaks to mainstream media really trying to, I don't even want to say that they're controlling the narrative. I just think that they're driven by profit, as a private company should be, but their profit comes in the form of getting clicks so they can sell ad rates to sponsors. And anytime you're in that position where you're driven by clicks, everything's just sensationalized. And it's either sensational or it's controversial, because if they can get people divided on it, so if they put out something about, let's just say, abortion, which I'm not diving into that topic by any means, but it's partisan. There's one side which is going to be really passionate about their position. There's another side that's passionate about theirs. And if they put out a topic about that, it all of a sudden becomes a lot of engagement in their world, with comments and people bickering back and forth. And anytime you can create that controversy or sensationalism, it drives clicks, which in turn drives their revenue. So it's a sad state of affairs when that's the world that we're living in, and the Ukraine war doesn't get the coverage that it did 3 months ago. That's a bit of a rant on why I just hate mainstream media, for sure.
I agree with you.
But I think the war itself does underscore the fact that there's these geopolitical tensions, and tensions isn't even doing it justice on how severe this issue is, because it's incredibly sad when you actually start seeing the horror and conflict these companies or these countries and citizens are going through. But this geopolitical tension, I don't think is getting any better. Like I think that if anything, we might see more of it. We might see China start wading into it with the Taiwan issue. We might see more issues if Finland wants to join NATO. Like there's so many things to be aware of, and I'm the farthest thing away from an expert in those areas, other than I just know that they all have major implications. It either disrupts the supply chain by raw commodities not being able to be delivered. It's obviously had an impact on underlying price of oil, which leads to gas increases, and we're all seeing that across the board. So that's in direct response to these European countries banning, to some extent, oil coming from Russia. So it does have a profound impact on all of us. And on the industrial real estate specifically, a lot of these companies are dealing with a lot of transportation. You can imagine like a logistics company, their job is to deliver something from point A to point B and perhaps several other points down the road as well. But their transportation costs amount for a considerable amount of their
Mm.
expenses. Those expenses go up if the revenue stays the same, or what we might even be faced with is depressing revenue in this environment, then there's less profit. If there's less profit, or perhaps there's even a loss, then that just all trickles throughout the economy. So it's a scary time. It really is. There's so much to try to follow as an investor that it can be overwhelming, and you almost don't even know where to start or where to look or where to analyze because there's just so much data.
Well, bring this all back around and putting a nice bow on it before we wrap this up. What advice would you give, if any, other than what we've discussed today, to those that are out there, again, navigating these murky waters that are looking to deploy capital, whether it be industrial or any other asset class? It doesn't really make a difference. But any advice that you'd leave them with before we wrap things up today, Chad?
Yeah, so taking into account all those negative factors that I mentioned, I believe that there's always reasons not to do something in real estate. Like there, no matter what point of time somebody considered making an investment in real estate, there's always reasons on why they could talk themselves out of it. And anybody considering it right now, all those things that we mentioned and many more are real reasons on why someone could talk themselves out of it. And I think if you do talk yourself out of it, you're going to be having to try and find when the next time to go into the market is.
Mm,
And there's always going to be factors on why you talk yourself out of it.
yeah.
So the last thing I would ever do is try to make investment advice. Everyone's got a different situation. They've got a different tolerance for risk. I just know myself, having done this for a while and having watched a lot of successful people do it, you have to accept some element of risk. You
Yes.
have to understand that even doing nothing comes with some amount of risk, and there isn't a perfect time to ever get into a property ever.
Hmm.
But I've seen a lot of people get very, very wealthy when smart people were saying you shouldn't be investing, now is not the time to do it, and then 10, 20 years later they looked very smart for doing it.
Yeah.
So I would just say that you always have to accept some risk as an investor, and now might just be one of those times where you have to even accept even more.
Yeah, I love it. I love every bit of it. I'm so glad that we had an opportunity to do a part number 2, and we'll probably be doing a part number 3 at some point in the future as well, because again, times are changing pretty fast. And so, but Chad, with that, I appreciate you coming back on, my friend. For those that are again interested in learning more about you, you've got your YouTube channel, you've got your podcast. Please share some information about how they can learn more about what you've got going on.
Yeah, much like you, Kevin, I just love talking about this stuff. I love talking about the good, the bad, the pitfalls. So that's YouTube's the best one if people want to reach out to and just connect with. Or LinkedIn is also, I'm pretty active on LinkedIn. So either one of those would be great.
It's a fantastic, your YouTube channel is fantastic. I mean, you cover some incredible topics there. So guys, definitely recommend you take some time and go. I don't know how many episodes do you have up there now? There's quite a bit of information.
Yeah, I've done probably over a hundred
Yeah.
hundred different videos now. So yeah, it's crazy to actually reflect back on that.
Yeah. Well, fantastic. Well, congrats on the success of the show. And again, thank you for coming on, Chad. It's always a pleasure.
Yeah, thanks again for having me on, Kevin. Really appreciate it.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.